Hi, this is Patrick Vernon from UNC Kenan-Flagler. In this VCIC training video, we will focus on returning more capital to our limited partners. At VCIC, your team will be making a decision about one investment in one startup. But your thinking can't stop with that one investment. The judges will want to know your plan to grow the venture to a successful exit. One of the defining characteristics of venture capital is that VCs are actively involved in helping their companies grow. They help a startup grow by being on the team. One of the rights that VCs receive with their preferred shares is board seats. As members of the board, VCs have an active role in shaping the strategy of a startup. Given their extended networks, VCs can add a lot of value beyond the money they've invested. This will apply directly to you at VCIC, as the judges will often ask, what else do you bring to the table other than cash? In the judging criteria, this is referred to as you're demonstrating your firm's value. A common misperception is that capital is a commodity and VC firms only compete on price. The reality is that VCs are professionals with reputations, and great VCs can demand better prices. Your team should know that you're competing with 5 other VC firms at VCIC. You'll need to be able to answer the question, why would a startup take a term sheet from your team instead of one of the other teams? You can make up anything you want regarding your hypothetical network and your hypothetical portfolio. I recommend doing some research to identify reasonable hypothetical connections that your team may have that could add value for this startup. I also recommend identifying one teammate as the deal lead who will serve on the board. The other way VCs help startups grow is to continue funding through a series of rounds. Recall that a VC fund life is 10 years. Your VCIC fund profile will usually put you in year 2 or 3 of the fund, still making new investments. Typical VC investments go through the same process: due diligence, Series A, hit some milestones, Series B, hit more milestones, after which there could be a Series C or an exit. This pattern will repeat itself for every startup in the portfolio, with variations to be expected. Understanding how your VCIC investment fits into your portfolio will help you respond to judges' questions in the partner meetings. For example, your team may not want 2 board seats with this startup, given how many other boards you'll need to cover. In the last video, we talked about spreading our investment across several rounds. This is called reserving capital, or keeping dry powder. VCs are very rarely one-and-done investors. If you have a startup at your VCIC event who doesn't understand this, part of your job as a VC is explaining this process and getting them on board. Now let's take a deeper look at how this works as we move from one round to the next. In each round, new shares are issued that stack on top of the old shares. The new shares have to be priced, and that price is based on the change in valuations between the rounds. Let's go step by step. I'm sure you recall the basic deal algebra: pre-money valuation plus the investment equals post-money valuation. Immediately after the deal, things start happening that will change the valuation of the startup. Good things can happen, like hitting milestones or discovering a new market, or bad things can happen, both internally at the startup or externally in the world. As we fast forward to the B round negotiations for pre-money valuation, the question becomes, what has happened since the post-money of the A? If a startup has succeeded in hitting its milestones, then we expect an up round. And at VCIC, you should definitely be projecting future up rounds. That means the pre-money valuation of the Series B is higher than the post-money of the Series A. The same number of shares exists, so the share price has gone up. For example, if the Series A was a 1-on-2 and the Series B was negotiated to a $6 million pre-money valuation, what would our original $1 million investment be worth on paper today? You can pause the video to think about it. In this case, the Series A post-money of $3 million has doubled to $6 million, meaning our original investment of $1 million is now worth $2 million on paper. I say on paper because this is an illiquid asset and we won't get our money back until we've exited this startup. So far, we've been talking about the negotiated pre-money valuation of the Series B. Now we can add the Series B investment. Let's say we anticipate a $4 million round on this $6 million pre-money, or a 4-on-6. The post-money valuation would be $10 million, and the Series B investors would have 40% ownership. What will actually happen is that new shares will be issued with a new share price dictated by the pre-money valuation. Just as the shares are getting stacked, so are the preferred rights that were negotiated with each round. As a rule, last money in gets priority. Again, all of this gets tracked in a cap table. I've got one at bit.ly/VCIC cap table if your team would like to get familiar with how to use one. Though I will caution that thinking like a VC requires understanding when to go micro and when to stay macro. When you're pre-Series A, you definitely need a vision for the Series B and Series C and the exit. But these are projections and not accounting. I'll leave it to your team to decide what level of detail you'd like to go to. Back to our example, the Series B investors got 40% ownership. That left 60% for the previous shareholders. I'm going to assume as the VCIC investors that we took the entire A round. We started with 33% ownership. Where are we after Series B? The answer is we've been diluted from 33% to 20%. Though we only own 20%, the value of our shares has gone up to $2 million. So why do we care about dilution? The answer comes from looking at the exit and the proceeds that we can expect at exit. Keep in mind that we're in a hits-driven model where we're not expecting a lot of big hits. So when we get one, we need to maximize our return. In this example, with a $250 million exit, being diluted from 33 to 20% results in over $30 million being lost. That same dilution in a billion-dollar unicorn exit would result in over $100 million being lost. When you're in a hits-driven industry and you have a potential hit on your hands, dilution is the enemy. Let's take a look at another dilution example. This time we'll start with a 4-on-6 Series A. We'll project a 10-on-20 Series B. That means a $10 million Series B investment on a $20 million pre-money valuation. That'll give us a $30 million post coming out of the B, and the B investors will own 33%. As Series A investors, we would lose a third of our original 40%, bringing us down to 27%. Notice that these examples have been for up rounds. That means things are going well. It gets much worse when things are not going well. The exact same Series B investment on a down round where valuation is dropped in half results in twice the dilution, putting us down to 13% in this case. A flat round in this scenario would put us at 20%. At VCIC, we're always projecting up rounds. It wouldn't make sense to make an investment if we presume the worst. That said, there is a term that we'll put in the term sheet to protect us from down round dilution. We'll discuss this in a later video. Back to our example, let's go through a Series C before we get to exit. We're going to build off our 4-on-6 and 10-on-20 A and B rounds. But first, pop quiz. If we go from a 4-on-6 to a 10-on-20, what was the valuation increase between the A and B? It was a 2x increase from a post of 10 to a pre of 20. Now let's project a C round, and once again, let's project an up round. We'll go 2x again. We'll do 20 on 60. A 20 on 60 round will result in 25% dilution to previous shareholders. So Series A is now down to 20%. If the Series C is the last round of funding before exit, these percentages will hold. Not including special terms like liquidation preferences, this is how the pie will be split at exit. Thankfully, we have a plan not to be diluted down to 20%. Recall that we're going to be spreading out our investment across several rounds, so we will participate in the B and C rounds. However, we won't have enough capital to take the entire rounds. We'll need to find Syndicate Partners. A syndicate is a group of VC funds all involved in the same round. Syndication is definitely the norm, and your VCIC team should be planning to syndicate future rounds. Back to our example, with the VCIC fund participating in every round and Syndicate Partners filling out the later rounds, we're able to mitigate dilution, and we end up at 37.5% ownership at exit. Now that you understand how it all works, here's the shortcut. The reality is the later rounds are speculative, and there's no reason to go into too much detail. Always reserve 2 to 3x whatever your investment in the A round is in an attempt to maintain pro rata ownership through exit. Specifically, at a VCIC event, you'd say something like this. We're proposing a 4-on-6 Series A, reserving $10 million for follow-on rounds, $14 million total in for just under 40% at exit. With that, we can calculate exactly what the exit needs to be for us to achieve a 10x return, for example. To achieve 10x on $14 million invested, we'd need 140 back, and 140 divided by 40% is $350 million. Some of you may be understandably uncomfortable with the way I'm rounding numbers, but given the level of speculation we're making about the future, rounding makes sense. You can now plug this bullet into your statement to the judges, and you need to do some exit analysis to see if a $350 million exit is feasible. We'll look at that in a later video. Another approach could be to use your fund size as the target return, since we're always hoping to return the fund. In this case, we'd need a $500 million exit to return a $200 million fund. Perhaps the best way to do it is to turn it around and let your exit analysis dictate the terms. If you've found comps or have other reason to believe there may be a $500 million exit here, and you know you have a $200 million fund, you'll need 40% at exit. That can be your guideline for a Series A. When I've said before that it's all about the exit, this is what I was talking about, negotiating today's deal terms with tomorrow's vision for success. If we think we need 40%, we can offer a 4-on-6 deal, reserve 2 to 3x to maintain pro rata, and we have a chance of returning the fund. I would consider that a baseline VCIC deal, a Series A offer with funds reserved for follow-on rounds and a specific exit scenario. To have a successful partner meeting at VCIC, your team should be able to fill in all of these blanks. To take it to the next level, your team should project the future rounds. And you do that not by diving into all the details of each round, but by understanding strategically what is driving these numbers. For example, looking at our 4-on-6 round, what is driving a $4 million investment? First and foremost is the amount needed to hit value-creating milestones. Your team may or may not agree with the pitching entrepreneur about what the milestones are and how much is needed. Your second consideration as a VC is your fund size. Can you invest this amount and reserve 2 to 3x to get to exit? Imagine we had a $50 million VCIC fund, for example. We would not be able to invest $4 million in a Series A, nor would we need 40% of the exit proceeds to return our fund. We would need to syndicate right out of the gate, in this case taking $1 million of the $4 million Series A. Moving on to the Series B, its pre-money valuation will be a function of how much value is created by hitting the milestones we will be funding with our Series A. The amount being raised in the Series B should be the amount needed to fund the next milestones. The same is true for the Series C, and the more your team is able to demonstrate to the judges that you understand how value will be created with this startup, the better your chance of winning your regional. I want to stress that I don't think your time is best spent modeling out the specific equity stake of all the syndicate partners. Much more important is understanding how each of these numbers is interrelated and understanding where the value inflection points are and how your capital will help create that value. All on the way to a moonshot exit, or perhaps, depending on your region, a more modest risk-adjusted exit. Nonetheless, the exit must be front of mind, and you should understand how the levers you're pulling in the Series A will set in motion a certain trajectory. I'll leave you with these key takeaways. This was the last in the Venture Capital 101 series. In the next set of videos, we'll look at a framework for screening startups. This is Patrick Vernon. See you next time.